start. Thank you for joining us on this rainy morning. My name is Anna Marie Kooning and I'm with Asset Preservation. We're a national 1031 exchange company and we're delighted to have you here. As you know, a 1031 exchange allows your customers, your clients, or yourselves to defer all or partially their capital gain taxes on investment property. Before we start, I want to give a few housekeeping. Number one, if you are here for Washington hours, could you raise your hand? We have a form that you must fill in, and you must sign it in both places. Those are the regulatories for the state of Washington. For Oregon and Washington credit hours, we will be giving out your certificates at the end of the presentation. And we'll have a couple of breaks this morning. So with me this morning, I'm delighted to introduce Scott Saunders. He happens to be my manager, my boss, the big guy for me. And he is a senior vice president with Asset Preservation. And I'm going to let him take over the program and tell you more about all his talents. Thank you.
All right. Good morning, everybody. I'm going to go without the mic. Can everybody hear me? Okay. By the way, we're Asset Preservation. We're a subsidiary of Stewart Title. They're our parent company. So one of the big advantages is they provide a lot of security to the funds. As some of you know, with some of the QIs, Summit here locally in Oregon, the security of the funds is a real critical issue, and our parent company does that. Hopefully everybody's got a handout in front of them, and what I'm going to do is go through some housekeeping. I'm not going to run through the whole outline and everything that we're going to cover, but we're going to track with this today, and as Anna Marie mentioned, we're going to have 2 short breaks, and then we'll get you 3 hours of credit. One of the things that I like in a presentation is I like to have questions. So if you got something I say that doesn't make sense, or you've got a real-life transaction, feel free to bring that up. And Amber back there is with Stewart Title. She is a vice president with commercial services. And if you've got title insurance or closing questions, she knows everything about that and is a great resource. So feel free to catch her at a break or get in touch with her. Amber, anything you want to say?
No.
All right. All right. So let's jump into it. Flip on over. I want to go through some terminology. Just out of curiosity, how many people have been in a 1031 exchange in the past year? Show of hands. Wow, that's a pretty good portion. I'd say it's at least half of the room have been involved in exchange. So what I want to do is just make sure we're all on the same ground. We will be covering a lot more advanced information, talking about partnerships, related parties. We'll be talking about reverse exchanges, what we call parking arrangements, different structures, pros and cons of different strategies. So we will get there, but I just want to make sure we're all on the same page when we talk about some basic terminology. So boot, you'll hear that a lot, and I'm going to give you a very simple definition of these things. Boot is simply defined as non-like-kind property. And there are 2 types of boot. There's cash boot, so those are cash proceeds you take out, and then mortgage boot, which is a reduction in the mortgage liabilities. So if a taxpayer has a $1 million mortgage on a property they're selling, and they only have a $900,000 mortgage on the one they buy, there's $100,000 of mortgage boot. So that's what boot is. Constructive receipt. This one comes up a lot. We get at Asset Preservation probably about 50 phone calls every month. They go something like this. We'll get them on a Monday morning, and somebody says, hey, I just closed on my transaction, but I haven't touched the money. Closed on Friday. The money's sitting over at such and such title company. We need to set up an exchange right away. And they call us on Monday after they've closed escrow. They have what's called constructive receipt of the funds, which means even if the money's at the title company or held in escrow, they signed as a seller, proceeds due seller, it's a fully taxable transaction. And we literally have 50 to maybe 70 phone calls every single month where people wanted to set up a 1031, but they waited too long. You can't, after you close escrow, go back after the fact and set up an exchange because they have constructive receipt of the funds. Can't be done. So one of the takeaways for you and your clients, you can always convert a taxable sale to a 1031 exchange right as you're closing escrow. We can get our documents there within 20 minutes and convert a taxable sale into a 1031 exchange. And we'd work very seamlessly with Stewart Title on doing that at the very last minute. So keep that in mind that you can set it up at the last minute there. Direct deeding. It's the direct transfer of title from your client, who we call the taxpayer, to the buyer, and then from the seller back to your client. In the old days, we used to use what was called sequential deeding, where title would pass through the qualified intermediary. We don't really do that unless it's a parking arrangement type transaction. I'm going to refer to the investor, what we call the exchanger, as the taxpayer throughout the presentation, but your client, the investor, taxpayer, is synonymous. The exchange agreement is the agreement with the QI that basically limits your client's rights to access the money, and it defines our relationship. The exchange period, let me ask you this. How many people here, just to show of hands, you've been involved in exchanges? Is the exchange period 180 days? How many people say it is? How many people say it isn't? There's a hand there, a couple brave souls. Believe it or not, the exchange period can be less than 180 days. I'll show you how later on. Or it can be more than 180 days. So 180 calendar days is the typical exchange period. But as we go into the class, I'll show you that it's a little more complicated than just 180 calendar days. The identification period is the first 45 days from when you close escrow. 45 calendar days to identify. Like-kind property. We're going to talk all about like-kind property. And I want to share with you some very creative things that are being done. We're doing a lot of easement transaction, conservation easements, cell towers, what's called a perpetual communication easement, energy, air rights, DST, what's known as Delaware Statutory Trust. So we're going to go into more detail on this later on, but there's a whole universe of transactions that are really expand beyond your typical cookie-cutter type exchange when we deal with like-kind property. The simple definition of like-kind property is any property held for productive use in a trade or business or held for investment. Mortgage boot, we talked about that. Sometimes you'll hear that referred to as debt relief because you go down on your mortgage liabilities. The qualified intermediary is the entity that facilitates the exchange. But depending on where your clients are coming from, they may refer to us as different things. So the IRS calls us a qualified intermediary. Anna Marie and I might refer to ourselves as a QI. We'll just abbreviate that. But you can hear us called an accommodator, a facilitator, an intermediary. All of those are synonymous terms for that entity in the middle that holds the money and structures the exchange. And then finally, relinquished property is a property that is given up by the taxpayer. But depending on where your client's located, you may hear that referred to as the sale property, the phase one property, or sometimes referred to as the down leg property. If you have clients coming out of Southern California, they'll call it the down leg property. Replacement property is the property being purchased, called the phase two property, target property, or the up leg property. So if you ever hear somebody say, I got a down leg and 3 up legs, they're selling one and they're buying 3 replacement properties. So that's kind of the takeaway there for you. A few more items on the next slide. A DST that we'll be talking about is a Delaware Statutory Trust. It's not a deferred sales trust. And some of you that are involved with commercial deals may have heard of a deferred sales trust, which is something completely different. The EAT is what we call an exchange accommodation title holder. So it's the entity that goes on title in a reverse or improvement type exchange. FTB is the Franchise Tax Board down in California, and that's significant because California has become very aggressive when it comes to 1031 exchanges and going after state taxes that are owed to the state of California through what's known as a clawback provision. So they've changed things recently there. And so you tend to see things on the West Coast originate in California and then spread throughout the Northwest. That's very typical. IRC is the Internal Revenue Code, and then the IRS obviously is the Internal Revenue Service. The net investment income tax, what we call the NIT, this didn't go away. We had a few weeks ago where the Republicans were not able to do the repeal and replace of Obamacare. So we still have this 3.8% tax, and I'll talk about it. It's still a part of the law. As of this morning, Donald Trump did an interview yesterday, and he said he's trying to still go after tax reform and get that repealed. So apparently, behind the scenes, the Trump administration's taking the lead on trying to negotiate some sort of healthcare reform. So we'll see what happens there. The QEAA is a qualified exchange accommodation arrangement, again in a parking arrangement or a reverse or improvement exchange. PLR is it's called a private letter rule. It applies to one individual, to this gentleman in his situation, in his unique facts and circumstances. But it's valuable for everybody because it gives us a little bit of the guidance, a little bit of the IRS's thinking on issues. So you might hear the term a PLR. A PIN is a partnership installment note, and Anna Marie will be talking about this later. It's a really creative solution when you've got a partnership selling an asset. Some partners want to do a 1031 exchange. Others want to take the money and pay the taxes on the property. And then finally, RevProc is a revenue procedure. Tenant common ownership was real big, starting back in 2002 till about 2008. Today, we see most fractional ownership programs. It applies to any property held for productive use in a trade or business or for investment. Section 1033 is what we know as the involuntary conversion. So if somebody's property is maybe taken for a municipality or they want to expand a highway, Section 1033 allows the taxpayer to get tax deferral if they reinvest in property that is similar or related in service or use within a 2-year period, and you don't need a QI for a 1033. 121, everybody's involved with residential real estate knows those are the primary residence rules. You can exclude $250,000 if you're single, $500,000 if you're married, if you live there 2 out of 5 years. 453 is seller carryback financing. It's when your client becomes the bank. And so they sell a property, they get some money as a down payment, and then they basically get paid over time and pay taxes as they receive the income. And some people think seller financing is a good deal. I tend to think of it as bleeding to death over a whole bunch of years. Rather than paying all your taxes in 1 year, you're going to pay all your capital gain taxes, but you're just going to split it up maybe over 5 years if you have a 5-year note. So this is fully taxable, but you just pay it in little increments year after year. And then finally, how many people are familiar with an UPREIT? Anybody familiar? A few hands. Section 721 is what's known as an UPREIT provision. When a REIT, a real estate investment trust, wants to buy your client's property, the way that this can be done is instead of giving them cash, which becomes taxable, they give them what are called OP units in the REIT. So it's another provision that allows for tax deferral, but it only applies if a REIT wants to buy your client's property. So if your client's selling an apartment complex and an apartment REIT buys it, they can do a 721 UPREIT. That's possible. But other than that, it really doesn't apply. Well, let's talk about what's going on with 1031 exchanges. And I call it the perfect storm. Remember the movie probably 10, 15 years ago now with Mark Wahlberg, George Clooney? They went out on a fishing boat, and they called it the perfect storm because 2 big storms collided and formed this one superstorm. We really have the same dynamic right now in the marketplace for 1031 exchanges. So we got much higher capital gain taxes. Percentage-wise, anybody want to take a guess how much capital gain taxes went up in 2013? How many people think they went up 5%? No hands. 10? 15? 30%. All right, write this one down. Percentage-wise, capital gain taxes went up 58%. So in 2013, we added a higher capital gain tax plus the net investment income tax, and it was a 58% increase in the tax rate. That's a huge hit to your clients.
Long-term gains went up?
Long-term gains went up from 15% to 20%. So long-term gains went up from 15 to 20, and then we had the new net investment income. So taxes went from 15% federal to 23.8. And if you back into the math, it's a 58% increase. So that means your clients that don't exchange are going to get absolutely slaughtered paying taxes. So that's one part of the perfect storm hitting real estate. The other one is, and this is great news, and the Northwest is a great example. The market's turned around for several years. It's a healthy market, right? Commercial, and we'll see that in a moment, is very strong. Residential strong. So the real estate market is healthy. We've got rising rents. We've got price appreciation. We've now got a situation, and I believe it's here. I'm not the local expert. Anna Marie is, but my understanding is inventory is pretty tight, right? The properties don't sit around that long, and if it's priced well, it's going to sell. So we've got a healthy real estate market, and for so many years we didn't. So the combination of higher capital gain taxes plus the healthy real estate market has led to just a surge of 1031 activity. So the 50% of you that raised your hands that you've been involved in an exchange, we're seeing that all over the country. People really don't have a choice. They're going to pay a massive amount of taxes. If they sell, they're going to pay a huge check to Uncle Sam and the state governments, or they're going to do a 1031 exchange, take that equity and roll it over into other properties. And as real estate professionals, as agents and brokers, you make a commission on the sale, you make a commission working with them on the purchase side. So it's a wonderful benefit for the taxpayer. And for you working with them, it gives you a tool. You've got a very highly motivated buyer that has a very limited time frame to pull something together. So let's look at what we face in taxes. This is kind of we've got 4 levels of taxation that your clients are going to face. First off, they're going to pay taxes on the depreciation recapture at a rate of 25%. So if your clients own an investment property for 20 years, if they sell it, they might forget that they've been getting the benefit of that depreciation year after year after year. And if they don't do an exchange, that tax rate's higher, it's 25%. Then you're going to add in the federal capital gains taxes, which could be either 15 or 20%. We'll look at that in a moment. Then you've got the additional 3.8% tax on what's called net investment income. So that came about in 2013 to pay for healthcare reform. And then you've also got the applicable state tax rate. So in Oregon, 9.9%. Your investors that are coming out of California, that can be 13.9%. When you add up all 4 levels of taxation, your clients are faced with a pretty significant tax hit. So that's something for them to be aware of. So let's kind of unpack this a little bit. Federal capital gain taxes. Anybody that is a single filer over $400,000 pays a 20% federal capital gain tax rate. And married couples filing jointly with over $450,000 income pay a 20% rate. Anybody notice anything odd about that?
Not double.
It's not double. There you go. It's a big marriage tax penalty. It should have been $400,000 and $800,000. So if you've got investors that are married, they're going to be facing the higher tax rate at a much lower level than a single filer. The old rate of 15% remains for other taxpayers. And then this net investment income tax, the same thing. This applies to what we call net investment income. So that includes interest, dividends, capital gains, income from partnerships. So think of it, the term that the tax writers use is called unearned income. So it's income that comes off of investments rather than W-2 wage income. And that is taxed if you're over certain thresholds at 3.8%. So again, if you're a single filer and have income over $200,000, you face this tax. And if you're married filing jointly, over $250,000. And again, it should have been $200,000, $400,000, but they were able to increase taxes on more people by having to hit married couples earlier. Yes, sir.
Is that $200,000 and $250,000 of net investment income or total income?
Good question. Total income is what it's based upon, and then when you have, let's say, capital gains, you add it to that. So you might have, let's just make a theoretical. Let's say I have no job income, and my capital gains was $230,000, and I'm single. Then I would be paying the 3.8% on just the $30,000 over the threshold. That's the way it's calculated. So you can see when you have to calculate your taxes, it's really important that your clients contact their tax advisor prior to closing escrow, right? This is pretty complicated stuff. It used to be I could tell you what your capital gain tax rate was. Now I got to ask, well, what's your income? Are you married or are you single? Do you have net investment income? You know, there are all sorts of moving targets. A way that you can do a great service to you and your clients is to have your clients call their CPA or tax advisor before they close escrow and find out, what are we going to pay in taxes if we don't do an exchange? Most of your clients will be absolutely shocked that they're going to be writing a check for 30, 40, 50% of what they're getting out of the transaction just to cover the taxes. Thus, that's driving the 1031 activity. You had a question there?
Where's that entity or the property held in a partnership?
And what does that affect?
versus being operating or as an individual?
At the end of the day, a lot of partnerships and LLCs are what we call pass-through entities. They're called, most of them are what are known as a disregarded entity, meaning it's disregarded for federal tax purposes. So if I'm Scott Saunders and I form my own LLC, all the income flows to me personally. You can do under what are known as the check the box rules. You can form an LLC that's taxed as a corporation. So it's a little more complicated than just is it a partnership or LLC. You gotta have to look at the structure. But at the end of the day, that income is gonna flow down to your client anyway, right? It's gonna flow down to somebody. So that's what happens there. So you got a huge tax hit. Now what I wanna look at, I'll go through this really quickly because this is more of a national picture. And in a few slides, I'm gonna turn this back over to Anna Marie. When we look at the market, I look at both the commercial market and residential. This is nationally. Commercial prices last year, nationally, ended up 24% above the previous peak. So again, I won't say this applies necessarily to the Portland or Northwest market. I think this is very strong and probably a good representation. But we're 24% above the peak that we hit in that 2007. And look at this graph. This is something I pulled last fall, but anybody that bought at the very bottom of the market here, they've seen their property double in value. So if your client bought a property for $1 million back in 2009, it's worth $2 million or more today, which again means they're going to be facing a huge, huge tax liability if they don't do a 1031 exchange. Residential, and again, this is the more national, we're right below the peak. Single-family rents are up about 2.5. It says here, I know in the Northwest they're more, Colorado or Met they're more, and year over year prices are up about 5.5%. So the bottom line, and then is this next slide. Your clients are going to be facing a really, really big tax liability if they don't do an exchange. So with that, what I want to do is turn this over to Anna Marie, who's going to walk you through the options on the next slide of what your clients can do when they sell a property. So with that, Anna Marie, you're on.
Thank you. Excuse me, I'm a lefty, so I need to come over here. All right, so what are your investors, the taxpayers, or yourselves, what are your options when you have a highly appreciated property? Well, number one, you could hold, watch your property continue to appreciate, and pay down the debt. But what if your client has a property that's in an area that doesn't have much appreciation, economic activity, job growth? Let's just say it's a flat economic area. Perhaps they need to sell, do an exchange into a property that has more upside to it, more potential for income, better job growth. So those are some things to consider if your client's going to hold. You need to tell them that. Number two, they could sell, right? You can always sell, you make your commission, you're happy. However, your clients are going to be hit with their capital gain taxes. And then they're going to have their net equity after tax dollars. How are they going to redeploy those into other investment vehicles where they're going to get the same return on investment as they did with their real estate? And then the third option, of course, is why we're here this morning, is to talk about 1031 exchanges. Here, your clients have the opportunity to defer all or partial capital gain taxes, right? And use those capital gain tax dollars to redeploy into other investment real estate. So why do an exchange? Well, obviously, you can defer all 4 levels of capital taxation. Perhaps you have non-income producing investment land and you want to do an exchange. Sell it and invest into an income producing piece of property. Maybe your property has a lot of equity into it, and you'd rather leverage that equity into a new property, bigger and better. How about diversification? Perhaps they're tired of the type of property that they're holding and like to get into a new kind of property. It doesn't matter what kind of class of property it is. And then a really good one is they have a fully depreciated property and they really need to sell it, do an exchange so they can acquire a new depreciation schedule. We see a lot of people doing management relief, right? They have multiple rental properties. They're tired of the Ts. They're tired of the trash, the termites, the tenants, the taxes. So they sell those multiple properties and buy a bigger piece of property that's only one. And also we have estate planning purposes for 1031s. We see our exchangers who have large buildings will sell those large pieces of property and exchange into multiple properties and designate each of those properties for one of their heirs. They can also buy those other properties in other geographical areas. So the code reads, no gain or loss shall be recognized on the exchange of property held for productive use in a trade, business, or for investment if such property is exchanged solely for property of like kind, which is to be held for trade, business, or for investment. So in English, that means any property held for investment may be exchanged for property held for investment anywhere in the United States. So we do have some exceptions to do a 1031. Obviously, we have stock and trade and other properties held for sale. What does that mean? Well, that means, for instance, a builder. What is their stock and trade? A builder has homes to sell, so they're held for primarily for sale. Also, this excludes those fix and flippers who are doing multiple sales during the year. Stocks obviously are not transferable in an exchange. We have other securities of indebtedness. Interest in a partnership. Obviously, a lot of properties are held in a partnership. However, the code interprets partnership interest as personal property. Therefore, personal property is exempt from doing a 1031 exchange. Partnership may do the exchange, but not the partners as a single interest. And we'll talk about how to unwind that for exchanges for those partners who want to get out of it. We have certificates of trust, obviously beneficial interests. And then the last one, choices in action, is when you have a legal right to a property but you don't actually own it. So all these are exempt from a 1031 exchange. So let's talk about property held for sale. Here is what the IRS looks at, right? They're going to look at what was the purpose of when you bought the property. Why did you buy it? What did you do with it when you owned it? And what was the property doing when you sold it? So they're going to look to see if you've done any capital improvements, claim them on your taxes, right? How many times have you bought and sold during the year? Is that your ordinary course of business? This is where they get the fix and flippers. Also, the extent of advertising and promotion and other efforts in soliciting buyers for the sale of property. Don't be alarmed. That's mostly, when they're advertising as a builder or, they're taking ads out in magazines. That's not for you as individuals with your clients. Okay, so this is a really good story about Allen versus the United States. So Allen had a piece of land. He bought it in 1987. He tried to develop it. Didn't work. Brought in some partners. They tried to develop it with him. Didn't work. So in 1999, he sold it to a developer. And he did a 1031 exchange. And he was audited. And they said, Mr. Allen, your exchange is not valid. Oh, yes, it is. I held that property for investment. And the IRS has two words that they love to say to you. Prove it. Right? So Mr. Allen was unable to prove that his intent changed from holding the property for development to holding the property for investment. Okay? This is important because it's all about intent with the IRS. So we had a question on partnerships earlier. So generally, as we just said, partnerships interests are regarded as personal property with the Internal Revenue. Now, what do you do when you have partners, some want to do an exchange, and maybe a partner or other partners want to get out of it and they want their money? Kind of like Jerry Maguire, right, from Show Me the Money. So what we can do here is, so if they want to exchange, they must convert that partnership interest into something. So how are they going to do it? Well, they're going to drop down into tenants in common as the owners of that property. And here are two separate ways that this is done. The first one is called drop and swap. So you have the partnership, right? You liquidate the partnership, close the checking accounts, and the respective partners will now drop down and deed out into tenants in common on that particular property. Then they go on to do their exchange. Those partners who want to stay intact will do exchange into the property, and the partner or partners who want their money will get their cash at the sale. The other way is called the swap and drop. Partnership stays intact all the way through the sale of their relinquished property into their replacement property, and then they drop out into tenants in common and liquidate the partnership after the exchange of the replacement property closing. However, there's some things with this, and one is the holding period. Can anyone here tell me how long you must hold a piece of investment property according to the Internal Revenue Code? Any guesses?
2 years.
2 years, talk to a tax attorney? Okay, that's a good answer, Randy. Well, that's interesting, because conservative tax advisors and investors will say 2 years. However, in the Internal Revenue Code, there is no definition on how long to hold a piece of property. So conservatively, yes, 2 years. Others will do a year, maybe under a year. So let's look at this. So with the partnership issue of dropping out into tenants in common, the holding question comes into play. The reason is, if they drop down into tenants in common before they do their exchange, the Internal Revenue Code is going to say, did you really hold that property as tenants in common for investment? Well, yes, we did. But the timing is tricky. And then, of course, if they do the swap and drop after the exchange, then they may question that as well. So the holding period, even though we don't have a black and white definition in the code, it still comes into play. We've had a number of cases that have been challenged, and they have favorable results for the partnership. Scott mentioned earlier here the franchise board in California, who is aggressively going after exchanges with partnerships. And then lastly, and this is important, we have a new form for partnerships, 1065. And on that form, they're able to detect if there was a drop and swap or a swap and drop, right there on the front page of that form. So the PIN is that partnership installment note. Well, what is that? Well, perhaps that departing partner, instead of receiving cash, would like to receive a note, right? Well, why would they want to do that? Some departing partners may want to have a note so that they can redeem it in the next tax year, because their taxes will be less. It's a financial strategy, basically, for those partners who want to take a partnership installment note. As soon as they redeem that note, they are taxed on it as income. But it is a way to not take the income in the year that the exchange happens with them as a departing partner. Okay. end of the day, it always boils down to who owns the property. The entity that sells is the entity that purchases. Right? So often I will get a call and saying, my wife and I want to do an exchange, we're going to sell a condo. I said, okay, how long do you hold the condo? Who owns the condo? Oh, my wife does. Well, if the wife is the taxpayer on the condo, even though it's a rental, if she sells, she's the one who has to do the exchange. LLC, they sell, they buy. Gemco Corporation relinquishes, Gemco acquires. So I assume that one of the first things you look at when you're taking a potential listing, you're going to call your title company and ask for a property profile. And the first thing you're going to look at is vesting, right? Well, that really is only one of the guidelines. And the reason for that is because of the partnerships and LLCs with a pass-through going down to the taxpayer as an individual. So vesting really is only one piece of the information. Carrying on with the LLCs and the partnerships, as we said, a lot of them are disregarded, therefore they do not exist in the eyes of the feds for tax reasons, right? But they maybe exist under the state, and yet they have a vesting that says something else. So that's why on an exchange and with the Internal Revenue Code, we're always looking at who is the taxpayer, who pays the taxes on the property. So taxpayer sells, taxpayer acquires in an exchange. We have LLC with 2 members, may be considered a single member LLC. Sometimes on a single member LLC, you have this other silent partner, and a lot of times that's with a banknote situation, just to kind of be aware of that. So related party. On the front page of like-kind exchange form 8824, half of the front page deals with related parties. Okay, who is a related party? Well, the obvious answer is those family members of lineal descent, right? Mother, father, brother, sister. Not step-parents, not aunts and uncles, cousins, none of that, of lineal descent. But wait a minute, there's more related parties. You have related parties in corporations and subsidiaries. So if the corporation or the LLC of those subsidiaries own 50% of the other company, they are a related party. Related parties have some restrictions on whether they can exchange or not. So they have 4 ways to do that. But remember, corporations and subsidiaries, it gets tricky. So how can you do an exchange with a related party? Well, one, you can do the simultaneous. They just swap properties. Scott Saunders and I are brother and sister. We both have rental houses. We just swap them out. No need to use a QI. We just trade properties. Number 2, I'm Anna Marie Kooning. I have a rental. I'm selling it. I'm doing an exchange. My brother, Scott Saunders, wants to buy my rental. That's perfectly fine as a related party. So the selling party is doing an exchange and the related party is purchasing it. All right, I'm Anna Marie. I'm still selling my rental. I'm doing an exchange. And I see my sister, Emily, has got a house for sale in another part of the country. I'm like, oh, I want to exchange into her property. I cannot. A related party selling, doing an exchange, cannot purchase from a related party. So that's not allowed. However, what is allowed, if I'm Anna Marie, selling my rental, doing an exchange. My sister Emily has a property she's selling and doing an exchange as well. If both parties are exchanging, then that is allowed. However, there are two restrictions on that. Number one, you must hold the property, both parties, for 2 years. Number two, your cash boot that's taken out of the exchange for either party is limited to 5%. So these are the 4 ways that related parties can or cannot do an exchange. All right, so I just talked about the, we had that private letter ruling in 2012. I talked about the must hold for 2 years, and then cash boot being limited to 5%. This next one, there was a related party exchange that kept exchanging for up to 540 days. It kept going, related party exchanging, related party exchanging, related party exchanging, and so forth. So that was quite the event. All right. So I'm going to mispronounce this name, and if someone can tell me how to pronounce it correctly, please let me know. The Malulani Group. All right. This is a good case. So the taxpayer, MBL, owned a subsidiary called the Malulani Corp. And the taxpayer wanted to do an exchange. MBL was unable to find replacement property until the last moment, the last minute of the 45th day, where he identified a piece of property owned by his wholly owned subsidiary, Malulani Group. He also used some operating losses to carry forward to offset part of the game as well. Well, his exchange was audited. And the IRS said, Mr. MBL, you can not purchase your replacement property from a related party. He's like, no, I had trouble finding property, and I just found this one at the last minute, and this is my exchange should be valid. Well, the IRS, as you can see, came out, but they had tax avoidance. That both entities were in a better tax situation after the exchange, right? Instead of paying capital gains. So that's why the related party issue is a very big deal with the Internal Revenue Code. Okay, like-kind property. You will see a number of different kinds of property coming on the screen here. This is a question I take weekly. What happens for those of you who are residential in the room, your clients are Googling 1031 exchanges and they see the word like kind, and they automatically think, oh, I gotta sell my rental and exchange it to another rental. Not true. So like kind property, according to the Treasury regulations, is broadly defined. You'll see a number of different images. We have oil and gas, we have cell towers, wind farms, vineyards, bare land, multifamily, industrial, vacation homes. These are all like-kind property. So like-kind property is any property held in a trade, business, or for investment that's exchanged into like-kind property that is held in trade, business, or for investment. Bottom line, investment real estate for investment real estate anywhere in the United States. All right, so what's excluded? Well, obviously, your primary residence is excluded. We all know that. And then property held for sale, dealer property. Dealer property deals with those who have stock of inventory of homes / a builder, maybe a fix and flipper who has a lot of properties. So what qualifies as real property? Again, any property held for investment may be exchanged for like-kind property held for investment. Now, has anyone done a personal property exchange here? Had a client do that? Okay, so there are personal property exchanges. What does that look like? Well, they're very narrowly defined by asset class. You'll get business aircraft for aircraft. You'll get heavy trucking for heavy trucking. Hotels You know, they have a real estate, I'm just doing an exchange right now with a hotel that's, you have your real property, and then they have some personal property, and that's, you know, the beds and the refrigerators and so forth. So you can do an exchange there. So I'm going to let Scott take over the creative light developments. And they're quite interesting, and it's just, yes, sir.
I have a question on the like-kind property. The reason I attended today is I have a client that has an income-producing property, then I have another client that has 2 oceanfront lots. They would like to swap, and they would like to see if they can take advantage of a 1031 exchange of some kind. And I just didn't know the answer to that.
Well, that's a very good question, because you can hold bare land for investment, but you must be able to substantiate your intent on holding bare land.
And what is a way to do that?
One of them is to let their tax advisor know, right?
Okay.
Right, because how do you do it? You're not taking depreciation, you're not making capital improvements, how do you do it? Well, you need to let your tax advisor know, / we're going to create the paper trail.
Can I ask you some questions about here? So you got 2 lots and improved property. What's the value of the improved property? How much equity, how much
The
debt?
improved property has a value of $575,000.
Okay,
The 2 lots on the ocean front have a value of $500,000.
okay. So let's unpack a few things with this scenario here. First of all, like kind can be bare land for improved for bare land. So anything you hold for investment qualifies. It doesn't have to be improved for improved or bare land for bare land. But you've also got some other issues to consider. So what Anna Marie was talking about was establish the intent to hold for investment. Every one of your clients wants to establish the investment intent. And I'm going to give you a great free takeaway on that. Whenever they buy an investment property, have them send a letter or an email to their CPA. We bought such and such property at the address, which we intend to what? Hold for investment. Where a lot of people make a mistake is they don't create that paper trail. Now you only need that if you get audited. What's your chance of an audit? Who knows today what the chances are of an audit in 2017? 0.5%. So the historical audit rate in America has been 1%, but because of reduced funding for the IRS, it's down now to about 0.5%. So if your client gets audited, it's up to them to be able to substantiate that they met the intent to hold for investment. So let's go back to your scenario, because swaps can happen and people can swap it, but both of them have to match their equity and debt. So your commercial property, is it free and clear or does it have debt against it?
It has debt against it.
How much debt?
$265.
Okay, and the land, does it have debt against it?
Free and clear.
Okay, so this is a great scenario. So 2 people want to swap properties, but I never look at it as a swap. You have 2 different exchangers. The one that owns a commercial property is an exchanger, and they've got it for the 550 and 265 debt, roughly.
575 to 265.
So
yes.
300,000 net equity, 265 debt. They want to go in and they want to buy land that's free and clear for $500,000, roughly, right?
Yes.
Okay. So they're going from a situation where they're going to go over here where they've got some equity and some debt, and now they're going to have all equity. The problem is going to be, if they're going to assume the loan on the commercial property, the people that own the 2 lots are going from $500,000 equity, and even though the value of the new property is pretty close, they're picking up debt, not all their equity goes in. They'll have a tax consequence. So anytime you're doing a swap of properties, you've got to look at each taxpayer as separate entities. What's their sales price? What's their debt? What's their net equity? Are they going to have, is all their net equity going to go in the replacement property, and do they have the same or greater amount of debt? So in your situation, the reason why swaps are very hard to do, somebody's going to have a tax consequence in your scenario. The people going from the land to the commercial property are really taking on debt, and not all their equity goes in. They'll have a tax consequence for that. So swaps can be done. They really only work, in my opinion, when you've got equity and debt that's the same, or they're both free and clear, and then they just swap it. Where we see a lot of swaps, the BLM. Somebody wants to open up a ski resort, and they want to swap out with the government 50 acres for some runs, and they want to swap out for a couple hundred acres over here, and so they swap out land that's free and clear. Ranchers that maybe where they know each other, They want to go ahead and they want to make their parcels, even rectangles because they got a weird corner. So they swap a little bit. They do a little land swap to even it out. Swaps happen 0.00001% of the time. They're almost impossible. So can it be done? Yes. Is it practical? Not really. That makes sense?
Yes.
Okay. Yeah.
I have a question about the validity of the intent.
Okay.
Go ahead.
What happens if we were deeded property, say 10 years ago,
Uh-huh.
and we've never told anyone
Okay.
that we want to exchange it?
Okay. So here's the question. You got a property 10 years ago, sat on it for a long time. So this is a really important question. Intent is very subjective, right?
Yeah.
What's my intent? So let's talk about something that has nothing to do with real estate. So I'm trying to lose weight. True story. I lost a little bit, but I got a lot more to lose. My intent this morning was to lose weight. That was my intent. Now I scarfed down those pastries there with a little chocolate and the Danish. I had 3 of those. This is true. So my intent was really pure, right? Objectively, before 10 o'clock, I ate 3 pastries with a lot of butter and calories in it. So the point being, when it comes to the IRS, your intent is here. What the IRS cares about are objective factors that either support or bolster your investment intent or contradict it. So let's go to your scenario. You've had land for 10 years. Did you intend to hold it for investment? Maybe, maybe not, right? Okay, the fact that you've held it for 10 years, and let's say you didn't put a for sale sign on it, means it probably was held for investment. But let's take, I say, that same piece of dirt and you put a for sale sign in the corner. There's a tax court decision where somebody sat on land for 12 years. Would everybody agree that's long enough for held for investment? We all would, wouldn't we?
Yeah.
Guess what? They didn't get 1031 treatment. They were a developer and they carried it on their books as inventory. They showed that they were trying to develop that land. So even though they had a 12-year holding period, their books revealed that their intent was to hold it for development. So intent, it's really important that you do what I've suggested. Send an email to your CPA or your tax attorney, your real estate attorney. When your clients are talking to you, have them send you an email. Oh, we're buying such and such fourplex, which we intend to hold for investment. So to go back to your scenario, you want to have a discussion where you sat down, by yourself or with your financial planners, and we decided we're going to hold this spare land for investment purposes, right? We've had it for 10 years. We're just holding it for long-term investment. I think this part of this Oregon is it's going to have a lot of appreciation, and this will go up in value. So it's all done based upon your unique facts and circumstances. The IRS doesn't care what your intent is. They care about objective facts that are provable. So create some facts for the IRS.
So the deed is dated 1952.
Okay?
And today, I decide, I need to create an intent.
Sure.
So I gotta go 2 more years from today's date?
No, you don't have to do that. No, you don't have to do. So, and remember, there's no 2-year holding period. So there's no, as Anna Marie correctly mentioned, there's no holding period anywhere in the tax code. So what do you want to do? Create the intent today. So start doing it today. And you know what you could say? I've been holding this property for 10 years because I believe this is a good long-term investment for appreciation purposes, right? Create anything you can to document that. It helps you out. So this is one area, we're 1031 experts, but we want to give you some practical planning tips. Speaking of practical, what I like to do, I knew you were asking me that. Let's take about a 5-minute stretch break. We've got more. Oh, there's a question in there.
Follow up on the gentleman, if I may, real quick, before we forget, where you got free and clear versus half encumbered.
Right.
If the encumbered party, if they had the means, could they knock out the debt so it's free and clear and then swap?
Great question.
Or could this one borrow half the, encumber it to the same percentage and then swap that?
The answer is yes. You could do either way. You can play it either way. But whenever I look at a swap, I never think of it as a swap. I've got, what's your name, sir?
Phil.
I got Phil, and your name?
Al.
I got Phil and Al. Phil's got a $500,000 piece of land. Al's got it. I'm going to look at Phil's situation first, and then I'll look at Al's second. Because they're both taxpayers, and you're on the hook for your taxes. So you might swap land, but still end up with a tax problem because you didn't look at your own situation. So you really And we're gonna go through this a little bit later. We call it the exchange equation. Whenever your clients sell, you're gonna look at the sales price, the loan payoff, the debt, and the net equity after closing costs. Then we're gonna look at what they buy. What do they purchase for? Did all the equity go over? Do they have the same or greater amount of debt? And that's really the analysis. It's very, very easy to do that. So let's take about a 5-minute or so stretch break, and the restrooms are down to the hall on the right, and then we'll kind of pick up.